Today I'm going to talk about how to avoid PMI. Now it's private mortgage insurance. I'm going to tell you what it is, how to avoid it, and most of all, I'm going to tell you something that you need to know before you sign on the dotted line and before you get the house that you want. If this is your first time at our channel or you haven't subscribed, click on the subscribe button at the bottom. My name is Travis Sickle, Certified Financial Planner with Sickle Hunter Financial Advisors. So private mortgage insurance, or PMI, what is it and how does it work? So PMI, private mortgage insurance, is used, as you guessed it, an insurance when you're paying less than 80% on your loan. So if you're buying a house for $200,000 and you want to put down the 20%, that's $40,000. Well, if you don't put down $40,000, then you're probably going to have private mortgage insurance, which covers just the lender in the event that you default on the loan. So it doesn't do anything for you. It's just a straight cost that you're paying because the mortgage company is assuming or thinking that there's a lot more risk because you're lending a lot more than the conventional 80-20 loan. And to be clear, this does nothing if you default on the loan. It doesn't help you at all. It only helps the lender. Because when you default on the loan, the bank gets the house back, unfortunately. So they have the house and they're not in the business of owning houses or selling houses. They want to stay in the mortgage business or the lending business. Well, if you're not lending anymore, then they don't want anything to do with that property. So they're going to sell it. And usually they sell them at a deep discount and they want to make sure that they're protected. And that's what the PMI does. Now, the three ways I'm going to talk about are three ways that you can use to avoid the PMI. So the first one is going to be lender financed. So the way that those loans work is the lender will just wrap that cost, or they'll pay the PMI, but they'll wrap a cost inside the loan. So let's say you put down 10% and then you're going to take out a loan for 90%. Well, if you did the traditional 80%, where you're putting down the 20%, the 80% is financed. Let's say it's at 4%. Maybe you'll get that 90% loan for 4.5% or 5%. Well, that is going to be for the entire life of the loan. So even if you start paying off that mortgage and you get above that 20% mark, it's not going to adjust the rate. So that rate is going to be stuck for the life of the loan. Now, that might be the only way that you can actually make the deal work and get into the house that you want, but that's an option. The second way to avoid PMI is to finance a portion of that 20%. So let's say you wanted to put down 5 or 10%. Well, there's still another 10 or 15%. So you have to get to the full 20, the extra 10 or 15%, then you would finance. And the way that that works, so it's basically a second line of credit or a second mortgage on the house, where again, you might have a little bit higher interest rate, but the primary mortgage or the conventional mortgage will still have that better rate or the traditional better rate compared to that home equity line of credit that you're getting on that second mortgage. So it might be 0.5 point or a point higher, depending on your credit score and everything else that gets factored into it. So you do have two separate mortgages. So while you might not be paying the actual PMI cost, you will have a higher interest rate on that second loan. But again, it's giving you the ability to avoid PMI and also to get the house. And that might be the only way to get the house or get the financing completed is to finance a portion of that 20%. So those are two ways that you can reduce it. Now, the third way is by far my favorite way. It's putting down the 20%. It's waiting until you have the 20% to go out and put down the 20% and then finance the rest in a conventional loan. Now, you're probably watching this video because you're trying to avoid PMI, so that third option might not be feasible for you at this point. But that brings me to the most important part. What are the risks? What do you need to know before you go out and get one of these loans? Whether it's this additional finance loan, which is also known as a piggyback loan, or is it just a loan where we're going to finance a larger portion at a higher rate? So it's one of those options is most likely what's going to occur. Now, what you need to know is because you're financing more, your payments are higher, and you also want to make sure that it fits in with your cash flow. But that's not the only thing you should be concerned about, because you want to make sure you have enough of a cash reserve. Now, if you're looking at the cash reserve, there's a good chance that it's not big enough or it's not built because you're struggling to put down the 20% as it is. And usually when we find this, we're dipping into the cash reserve to get that 20%, which is also a huge mistake. You want to make sure that you have your cash reserve in place, especially if you have a larger mortgage. It's more risk because you have a bigger payment. So you want to make sure you have a solid cash reserve. Now, if you have a higher payment and you have a low cash reserve, you're really at the mercy of the market and your job. If you lose your job, you're going to struggle to make those payments. And if there's a downturn in the market, it's going to be really difficult to refinance. If you're trying to refinance because you originally went into a loan that had a higher rate and you want a better rate, that might be really, really difficult. And another one is looking at the opportunity. Think of the opportunity of getting a promotion or a job opportunity somewhere else where you need to move. But if there's a downturn in the market, then it's going to make it really difficult to sell it because there might not be enough equity built up in the house to even sell it so you can actually pay off the loan and move on with your life. So it could really put you in quite a bind and put all the equity that you've currently built up at risk. A big selling point of using these loans is building equity in the house, saying that the housing market is stable and it's going to continue to increase and you're going to have this massive amount of equity down the road. But that's not always the case. If you look back to 2008, a lot of that same stuff was thought out and went after in the housing market, but we all know how that ends. They got into a jam, you can't make the payments, and you lose absolutely everything. And we're not just talking about a house, we're talking about the roof over you and your family's heads. So you want to make sure that you're financially smart, making financially smart decisions. So possibly looking at renting for a couple of years before you can afford to put down that 20%. Now, if that seems like a huge feat, then you should probably also reconsider the loan, because these are real dollars and these are real costs and they have real impacts on your future financial stability, you getting to retirement and reaching all of your other financial goals. And the last point about trying to avoid PMI and getting in a bigger loan that you probably can afford, you really want to consider and question whether or not this is an investment, because it's probably not, because there's a good chance that you're not going to downsize your house in the near future. And saying that you're building equity in your house as an investment is a real challenge, because it's very infrequent that someone actually downsizes so they can have the equity in their house on their own terms. So while there are ways to avoid PMI, you want to look at your particular situation, make sure it works, and make sure that you can afford it. If you've enjoyed this video, be sure to subscribe and leave your comments down at the bottom.